broadcasting now. All right, hello everyone. Thank you for joining us this afternoon, Singapore time, and morning if you're dialing in from Europe. So my name is Thomas Glucksmann, and I'm joined by an esteemed panel of experts in the cryptocurrency and cybersecurity domains to talk about the idea of a three-pronged approach to the protection of digital assets. So I'll let the panelists introduce themselves first before I get into the panel discussion itself. So Mrigank, if you'd like to get started, that would be great.
Sure. Hi everyone. Good afternoon. So I'm Mrigank, one of the co-founders and the CEO of Merkle Science. So our company essentially provides blockchain monitoring risk services to detect illicit use of cryptocurrencies. So this is used as an AML solution by cryptocurrency companies, custodians such as OnChain, and it's used as a forensic service by law enforcement agencies. In terms of my background, I've been working in the cryptocurrency space for about the last 5 years now. Before that, I was in investment banking. Just before Merkle Science, I was working for a company called Luno. It's a cryptocurrency exchange headquartered in London and across Africa, Southeast Asia, and Europe. They just yesterday, they got acquired by Digital Currency Group. So it's definitely been an interesting journey in the cryptocurrency space so far.
Great, thanks, Mriganka. Alex, if you could go next, please.
Sure. So my name is Alexandre Kesh. I'm the CEO and co-founder of OnChain Custodian. So OnChain Custodian is a digital asset custody and open finance service provider here in Singapore. We aim to be compliant, secure, and effective and efficient for our customers who are business and high net worth individuals. On my side, I used to work for the banking and capital market industry for about 22 years before that, first at the Bank of New York Mellon and then at Swift for 18 years.
Great. And Rory, if you could introduce yourself as well, please.
Yeah, absolutely. Yeah, good afternoon, everyone. My name is Rory Young and I work at Lockton. For those who don't know, Lockton is the largest privately owned insurance broker in the world, and the division that I work within for Lockton is the Global Cyber and Technology Division, which is essentially a group of about 50 plus individuals spanning right from the US through to London, Asia, and Australia that really focus on the risk transfer solutions for everything related to network security, failure, privacy liability, intellectual property infringement, and emerging risks such as cryptocurrency, digital assets, and the alike. And I've been part of Lockton for the best part of 7 years within that team.
Great, and thank you everyone for the overview. So just a reminder to those that have joined us now on the webinar, if you do have any questions for the panelists, you can actually use the Q&A feature within the Zoom webinar, and then we'll allocate some time at the end to actually answer some of these as well. All right, so also just quickly about myself. So I'm the founder of Asia Pacific Security, which is a market intelligence platform focusing on the cybersecurity industry in APAC. All right, so now that everyone's been introduced, I'd like to dive straight into the panel. So given that the public perception of cryptocurrency over the years has been somewhat negatively impacted by a lot of the news articles regarding hacks and heists and all this cybercrime activity. So I wanted to actually start off with getting the view from Alex in terms of, what have actually been the options for protecting cryptocurrencies over time, given that now, you know, it's almost 10 years that this industry has really been up and coming?
We can start at the very, very beginning of the industry, which was about 11 years ago, where in fact you would keep your private keys on a piece of paper. Really, that was the solution, and you would have to save them somewhere in a safe or in a drawer with a key. And obviously, if you lose that private key paper, you lose everything. So there was quite a few incidents at the beginning for that reason, and obviously. As the industry grew, some technical and technological solutions have been found, wallets providers, hardware providers like Ledger, for example, enabling users to keep their private keys in a secure device in a way. That has also evolved into multi-signature processes whereby you need multiple party holding multiple keys to sign transactions physically. And then that's all cold storage, as we call it. So something that is offline and secured offline. Not the most efficient way, obviously. And as the industry has been growing and demanding for more velocity in terms of transaction signing, other type of solutions have emerged. For example, reusing what the banking industry has been used successfully for many years, the use of hardware security modules, HSMs, provided by providers like IBM, for example, the one we're using. Also multi-party computation, which is a way of splitting private keys into multiple secrets, or that will be evoked at the time a signature is required. And those secrets are stored in multiple devices, multiple geographies, and so on and so forth. So as you can see, it has evolved dramatically since the very beginning. I think now we are definitely in a world where enterprise-grade custody is possible through HSM or MPC type of processes and technology. And I'm sure we will discuss a bit more about that in the next minutes. In our case, we're using a combination of cold storage, multi-signature, stored in hardware devices that are physically held in safes. That's for the long holders, as we call them, the ones that all need velocity for transaction. And we also use for our warm wallet solution and HD wallet solution, HSM, which are FIPS level 4 certified, provided by IBM, and that we use in the cloud to ensure that we have access to those HSMs even in the period of COVID where we need to work from home.
Great, thanks very much for that comprehensive overview. It's definitely interesting to see the evolution of the enterprise grade solutions, particularly even since I got started in the space back in 2013. Out of interest, just for the other panelists, what solutions do you use, to protect your own crypto assets, personally? I mean, Regank, what do you use to protect your crypto?
Yeah, I mean, I typically just use hardware wallets and not too complex. I feel more secure if it's with me and locked up in my safe.
Yeah, I was going to add. It's funny. Alex should start off with the history of security when it comes to this. I think so. I still have a piece of paper at home with my long sort of list of numbers and little letters that sits. But again, I guess I'm dealing with it maybe as a relatively small amount. But that's what I use. It's a piece of paper that has my keys on it.
Yeah, in my case, I'm using. I have to be honest. My personal crypto are held at either exchanges or service providers I trust have the best security behind the scene. For example, Celsius Network, where I do some deposits for yield. I know they're using good custodians. Same for the exchanges that I'm using. I'm making sure that they are using good custodians at the back. I don't trust exchanges who do custody on their own because that's not our business. And I think they have proven over the years that they're generally not very good at security and securing the assets of their customers.
Yeah, no, that's definitely an understatement. I mean, I've worked at 2 exchanges that both got hacked, so definitely agree with that. So actually going into the topic of hacks, given now both the maturity of the ecosystem has evolved and more attention is being placed on digital assets as an up and coming asset class, but at the same time, it means that this honeypot from the view of cyber criminals has also grown. So Rory, I'd like to get your take on what some of the major cyber security or security challenges and risks you're seeing a lot of the digital asset firms facing at the moment.
Yeah, no, absolutely. And I think you've really hit the nail on the head when it comes to, and just to emphasize your point on the cyber criminals piece, I think if I was to look at one of the largest risks when it comes to the safekeeping of any digital asset, if we're talking from the data that we hold right through to cryptocurrency and digital assets from that point of view, ultimately financial motivation is the biggest driver behind the risk for these businesses. So as long as there's a return when it comes to the investment of these cyber criminals and what their activity is and what they're gaining from it, then that risk always exists. I think if we're talking about a particular example, what we are seeing is that it's a blend between hackers getting access to systems and then influencing the employees of those companies. So we've all, it's not new, but it's just what we're seeing become more prevalent. It's the compromise of an Outlook inbox. So it's a criminal, a hacker, some sort of third party getting access to the Outlook of an executive of a business. They're doing the reconnaissance as part of that inbox. They're learning the language of directors between departments and where authorization can take part. And for a digital asset company, this could mean the approval of whitelist potentially when it comes to the withdrawal of assets. If there's, they learn that there's two custodians in particular where there isn't maybe a separation of accountability. And once they learn that sort of relationship exists, it's then manipulating the language that could add, a potential compromised address when it comes to the safekeeping of assets on clients' behalf. And this also goes for the same for a lot of businesses when it comes to the approval of any sort of fund transfer, not just necessarily the safekeeping of digital assets, but that's certainly what we're seeing. It's companies that they're ultimately, their security is failing for what is a very, it could be a basic application such as your Outlook, your email inbox. But from there, it's really a hacker learning the trade, learning the language, getting access to what they need to, and then at an opportune moment, creating something that seems legitimate and relying on, another employee of the business that has particular authorization to then sanction something that would lead to either the transfer of digital assets, the wrong depositing, the adding of an address that should not be there. And in more sort of typical circumstances, it's the approval of a bank account where something needs to get paid, or even a list of a database of employees' data, which could be useful to criminals as well. I think that's certainly what we're seeing, from a specific example.
Yeah, no, it's definitely something I think that is interesting with this ecosystem, that you've got attacks coming from all directions and all variety of attacks, and now that there's so much at stake, as you mentioned, in terms of asset size, the sophistication of social engineering attacks or insider threats is definitely increasing. So Mrigank, given that Merkle Science does a lot of work in the, let's say, post-incident side, when a criminal activity has happened, what are some of the kind of trends or developments you're seeing with how criminals are sending funds from exchanges that have been compromised, or how are they actually acquiring cryptocurrency using criminal means?
Yeah, so I think that in terms of using criminal means and ways of acquisition, there's actually been an upsurge in cryptocurrency related crime in the past few months, primarily due to COVID and everybody being online. So we're seeing a huge uptick in COVID related crimes. So COVID related ransomware scams, COVID related scams where people send money for donations to criminals, but it just ends up with them. So the Twitter hack was actually a good example of that, where essentially Joe Biden, Barack Obama's Twitter accounts were all hacked, and they said that I'm feeling generous due to COVID and send me $1,000 and I'm going to give you $2,000. So we're definitely seeing a huge uptick in COVID related crimes. And then the second other interesting aspect is as decentralized finance is becoming bigger. So there's a lot of hype around it. So there are a lot of incidents that occur, which might not technically be crimes, are more in the market manipulation realm, but consumers lose their money as well. So, I mean, without getting into the complexities, essentially like the DYDX hack, where they would utilize an exploitation in the smart contract to basically earn a lot of money out of it. So as these complex derivative products or complex DeFi products keep getting added onto crypto, there'd probably be a much larger amount of those as well. They might not even technically classify, like they're not traditional crimes like a hack or a scam, because this person's actually exploiting the system. It's like making a great trade. But potentially regulators will eventually clamp down on it. It falls more in the market manipulation realm. And I guess the last interesting trend we've seen is, I think when we started doing this, crypto to crypto exchanges were the most common avenues for criminals to liquidate their funds. So all these hackers, scammers would always send it to the larger crypto to crypto exchanges. But as I think more and more regulations came about and all these companies were under the purview of regulations, they've implemented AML procedures now. So we've seen movement from those crypto exchanges to actually payment processors and other decentralized finance companies. These are becoming the preferred modes for laundering by criminals as well. Yeah, so and it's I'm guessing that as once that segment gets regulated, then there'll be a new emergence of some other essential new cryptocurrencies or new methods which criminals will use for laundering as well. So yeah.
Great. Yeah, no, thanks for the overview there. I think a lot of it raises a lot of questions around how are regulators going to approach decentralized finance or DeFi, particularly when you have all these different means of exploitation. I mean, the whole idea that like code is law, and what does that mean when an incident takes place? When there's so much money at stake. And especially on a immutable network where you're not supposed to be able to reverse transactions. So these are all very interesting trends. I think particularly those tuning in the audience will find interesting. Moving on now more towards the institutional view of things, I definitely have seen myself that one major barrier for institutional adoption was because of the high number of attacks and criminal activity within the crypto space, and there just weren't the solutions available. It seems that now there is, and Alexander and OnChain is offering one of these solutions to actually address those concerns. So I'd love to actually learn more. First of all, particularly for those in the audience who aren't aware of, what exactly is a cryptocurrency custodian? How does it compare to a traditional custodian service? So Alex, if you could take us through that, that'd be great.
Sure. So custodians really have the objective of providing transparency. That's one for those corporate entities that needs that transparency for auditing purposes, for example, but also obviously the security of accessing those digital assets. So what do we do as a custodian is actually preserving the access to the private keys that will give right to those assets. And we do that for funds, family offices, high net worth individuals, for example, just to take those three examples, because those type of players cannot hold their assets on a ledger into a safe. The funds would not be able to do that because these are the funds of their customers, and these generally in the traditional space needs to be handled by a third party. So that's the reason. For high net worth individuals and family offices, same challenge. And beyond managing safely those assets and access to those assets, there is also the question of what happens when I die, for example, where those assets will be transferred to. Are my are going to have the assets that I've managed to invest in during my lifetime. So those considerations lead to the use of a third party that will look after those assets like a custodian would do. But the difference with a traditional custodians or bank would do, but the difference with a traditional custodian is that in our case, it's more a cybersecurity play whereby we secure the access to the private keys that gives access to those assets. Beyond that, I think a trend, we mentioned DeFi just before, I prefer to call open finance because it's DeFi and CeFi. There are different ways of investing digital assets nowadays. So there is more and more interest in earning a yield from those assets. So you can do that in multiple ways. And custodians like On-Chain Custodian, for example, give access to partners who can, through lending or investment products, pay a yield sometimes up to 12%, for example, in some stable coins to the investors. So custody, securing the assets and providing transparency and third-party neutrality in the process, and curated investment offering through partners that we have done due diligence against.
Thanks. I think members of the audience who weren't aware would be enlightened by that overview. Out of interest, how do you, as a custodian, differentiate yourself against the other competitors you have in the space?
So I think in our case, well, security, I think most custodians have the right level of security, and they should have, because that's their core business. So I don't think nobody's really competing on security. I think it's more around the jurisdiction and the regional focus you have. In our case, it's Asia Pacific, and we're based in Singapore. Jurisdiction is important because obviously different regulatory framework exists depending on where you are. We have, for example, customers who are not comfortable with custodians in the US because of the tendency of US regulators to clamp down on players just like that overnight, and prefer to have their assets close to them in Asia Pacific. So jurisdiction is an important differentiator. And thirdly, I would say the service, as any company. Different types of service. Big custodians would have more a standard way of serving their customer. In our case, we are a small custodian, so we praise ourselves of being like a private bank in terms of approach to relationship management. And I think that's important. And finally, obviously, it's insurance. And we have our insurance broker on the panel, Lockton. Having an insurance coverage which is sufficient enough and also demonstrate that your operational and technological environment is secure enough is essential. There might be some differentiator there. Some will say the amount is important. I'd rather say the coverage is more important and how deep your insurance is covering you, rather than just a big number that in fact cover only cold storage, for example.
Great. No, that's very interesting in terms of the point about jurisdiction. I would always assume in a space that operates in a very decentralized way that would be actually less important, but it makes sense that when you're talking about the ability for a regulator to come in and just take away your assets like that, it definitely makes sense. So Rory, I know I'm going to ask you some more detailed questions about insurance a bit later on in the panel, but given that Alexandre just made the point about insurance in terms of custody, was there any initial comments you wanted to make before we go into a bit more detail later on?
It's quite a big topic, so we can go into it now if you want.
Yeah, maybe we can just put it on pause, and then I'll ask you a bit more detail about that in a minute. Because one thing that is a nice, let's say, parallel to the idea of custody being regulated is the fact that now you have so much emphasis on compliance coming from all these different angles. And Regan, given that one of Merkle Science's core products is offering this AML compliance platform with regards to the types of transactions that digital assets firms are allowing. What are you seeing in terms of some of the challenges for firms to actually adopt many of these compliance technologies? Is it too burdensome to deal with all the regulation? Are the costs of compliance actually getting out of control?
Yeah, so I think that there is definitely an increase in costs of compliance as there's more and more regulation coming about, not just in Asia Pacific but globally. So but that isn't the key impediment. I guess in terms of adoption of compliance technology, the major issue that a lot of players out there have is the regulatory ambiguity. So take, for example, the FATF travel rule. We're at the beginning, literally the beginning of a completely new industry. And on top of that, there are regulations that are just getting formulated. So then there are several spaces which, because of the regulatory regimes, there are several spaces that don't have enough clarity. So players don't know what to do in certain cases. So that's a big issue for them. And on the second, and on the other hand, of course, because the space is constantly evolving, newer risks come up. So you can't really look to the past. So an open finance company which has just had a hack where there's an exploitation, they can't look back and try and cover up their bases by looking at examples of multiple things that have happened in the past, because what they're doing is completely new. So a completely new form of threat might emerge. So I'd say these are the two bigger challenges. And in terms of increasing compliance costs, that while of course that is something that businesses have to think about, it comes with the added advantage of more credibility as well. So now that so back when I worked for Luno around 4 years ago, and there was a lot of regulatory ambiguity in Singapore, Malaysia, the rest of Southeast Asia. So we struggled a lot more as an exchange to gain credibility. Whereas now, if you're an exchange in one of these geographies, there are very clear regulatory guidelines. So although there's an added cost of compliance, there is the corresponding increase in trust that comes with it. Because crypto is regulated, a regulated exchange will have more customers that trust them, and even more institutions that trust their money with that exchange. So I think that's pretty much the trend that we're seeing.
And then on the topic of trust, this is a good segue back into the topic of insurance. So Rory, I'd like to really get a sense of what the current state of insurance offerings are for the digital asset ecosystem, not just here in Asia Pacific, but also more broadly, what you're seeing globally, and perhaps even some of the offerings that Lockton specifically has now. If you could give us an overview, that would be great.
Yeah, absolutely. And I think a good place to start before we go into crypto related or digital asset loss sort of insurance market itself is to really start with what some of the other insurance lines are sort of doing and the trends that we're seeing. And we talk about insurance for a custodian or the safekeeping digital assets. We do focus on what is known traditionally as this crime market, and take crypto to one side. We are seeing a trend in the normal crime market. So we're talking, the stealing of funds and etc. That's actually already going on an upwards trend, just given the activity that, from a loss point of view, that insurers are seeing from a traditional sense. And that's really been driven from a cyber criminal and online perspective. So once we understand that from that point of view, it's changing, there's an upward trend in premium. This relates to the fact that there's more loss, and that loss is related to an online exposure that hasn't necessarily been as prevalent as it has today when it comes to the successful underwriting. We couple that in with a risk class such as cryptocurrency digital assets that is extremely limited, and ultimately it just means that it's a tough market for the buyer. To summarize, there's a very limited amount of insurance companies that are happy to explore and go down a journey of looking at and assessing risk for a crypto related company, let alone a custodian. And part of it is down to the fact that there is it's a mixture between kind of global mandates where the insurers, they either don't understand something or they have the willingness not to understand. And a lot of companies that we would look to engage when it comes to risk transfer solutions, it's not necessarily because yeah, they don't want to do it, is they don't understand and they don't have the mandate to understand. So I think straight off the bat, the insurance market globally, it just means that there's very limited amount of insurers that you're able to deal with. And when that happens, it makes the from a buying perspective quite difficult, because you're faced with limited choice, and you have to be creative in terms of you know, what you can do and what is viable. In terms of I guess from a coverage point of view, I think it would be fair to say that from a cold wallet perspective, this is becoming more standardized within the insurance industry. There's certainly appetite to recognize this sort of risk and actually offer something that's viable and, you know, in some ways affordable. And then when we actually start to understand and incorporate, you know, HSM devices and what's more considered more warm wallet exposure, and then going into a hot wallet where if you're in exchange, it's you know, it's part of your business to create some sort of efficiency when it comes to transactions and dealing with digital assets. That becomes even more sort of limited and harder to gain in the insurance industry, but it's there. So I would say it's come a long way in the last couple of years. I think Lockton, we've looked at it for probably the last three or so years. But from when we started, when it was right, you know, who do we know that's even going to look at this? Now we're kind of going, right, for a custodian, we know that their priority is the safekeeping of digital assets. It's seen a lot more favorably than if we were to try and go into the market for it with an exchange, for example, where efficiency and customer sort of turnover is actually their priority over security. So there's a big difference in the way that those, you know, those are seen in the insurance market in general. And then you couple that with the technology that is used. And today, yes, if it's a, you know, an entire cold wallet procedure, that's going to be seen a lot more favorably, and arguably it'll be a lot easier to gain coverage for that. But it's that trade-off between efficiency and what the business is trying to do for their customers. We know that it's not necessarily 100%, you know, appropriate to have that type of technology, but when you try to actually therefore then get it recognized under the insurance, lo and behold, it creates costs, it creates more understanding, it creates worry for the insurers, because their ultimate goal is firstly trying to understand where loss can arise from, and then secondly it's managing to successfully underwrite this sort of loss whereby they're sort of charging the right premiums, where it's going to be fair and reflective of loss scenarios that for a pool of groups, say a group of 10, is going to be sort of 1 in 10 having that loss and being able to pay out for. So it's interesting. It's certainly challenging, but we certainly we've been seeing quite a big uplift in the amount of inquiries that we see, and it's driven by regulation, namely. You know, in Hong Kong, we talk about the SFC with their licensing for virtual asset exchanges. Part of it is that insurance solution for these assets. So I think, you know, it's a challenge as an opportunity, as much as a challenge as it is an opportunity, because ultimately, yes, it's challenging that, you know, insurance is a hurdle that some of these companies are having to jump over. But from an insurance point of view, like at least the FCC are recognizing and going through this application, and it's creating that level of comfort for the insurance market that you're going through these, you know, this quite an extensive due diligence and actually demonstrating all of your operational technology and people risk through your ordinary course of dealing with the SFC. And once that gets translated to the insurer, they're getting more comfort that it's becoming part of this regulated business. So it's interesting times. I think it's only going to develop further and further whilst the insurance market gets more comfortable. Yeah.
Oh, great. That's it's interesting that you talked about the offerings are still let's say relatively limited, given that it's quite a new you know, ecosystem from the insurance side. I remember about 5 years ago working for an exchange, and we were approached by an insurance company who they came to us, but they just had no idea that they knew there was something there. I don't know if that company is as active in this space at all, but I just found that very interesting. And one thing that would be I think interesting to know is how the premiums compare to other types of fintech companies. who may not be dealing with crypto per se, but you know, they're still dealing with finance. So I mean, if you had any view on that, it'd be I think the audience would be keen to know.
Yeah. The best way to make the comparisons are if we think about, you know, I don't know, 2 or 3 major different types of insurance that a company would buy. The focus is, you know, for today's topic is that crime piece. It's the loss of an asset and the reimbursement that you're looking to get from that. But another could be, say, you know, the directors and officers liability. So it's that policy that would help pay damages awarded against a director for a breach of duty, etc. But it's fair to say that when it comes to crypto-related risk, we're looking at quite a significant surcharge in premium that you would expect from, you know, a traditional financial institution, and it's not necessarily related to, you know, the amount they pay, but certainly the rate that they're getting. So your financial institution, you know, you take a bank or it could be a hedge fund, whoever it may be, chances are that they could have billions in AUM. They could have been established for 25, 30 plus years. Their customer base is XYZ or whoever it may be. The premium they pay could be similar to, you know, a startup cryptocurrency company, but the cryptocurrency company is as a startup nature is dealing with its own costs. They've got balance sheet worry. So the difference is not so much that there's so much difference in price, but the cryptocurrency company is facing quite a high cost off the bat for what could be quite a small limit, whereas the traditional are buying big limits and they're all quite comfortable in paying that amount because they're so established. So that's kind of the difference. But yeah, I think on the whole, it's certainly quite a big surcharge. Whenever you sort of mention that it's related to crypto, it's related to blockchain, it's related to digital assets, then you could expect there to be a fair surcharge. Makes
sense. And besides the work you do with custodians and also potentially with exchanges, have you seen much demand from individuals, like particularly the high net worth individuals, looking for insurance, like whether they are doing self-custody or whether they have assets deposited, you know, with a custodian?
Yeah, so we have seen some interest, and it does normally get pinned through and come through the custodian, in fact. So a lot of these clients, they'll already be engaging with a custodian, and they'll say, look, we understand that we're insured through our custodian. It might not be, say, 100% of our assets, so they're looking to buy their own dedicated limit. So what they would say is, you know, if I deposit $15 million worth of digital assets, I want to have my own dedicated insurance limit for that. And what can you do? And at that point, it's the custodian's job. Well, for the custodian, if they've already gone through the underwriting process whereby they've already got an insurer that's familiar with their technology, it would just simply be a case of them referring and going through a process and being able to do that. I can't say that a lot of high net wealth individuals have taken it up. There's probably interest. The solutions are there, but it does ordinarily take them to have already engaged with a custodian that has insurance in place. Because, you know, if you're a high net wealth and you either self-custody or you go through a custodian that doesn't necessarily have insurance, all that's going to happen at the end of it is the insurance company will say, look, there's something we can do, but we're going to need to go through the whole process of underwriting you, doing the assessment, X, Y, Z. And for a lot of people, that's either impractical to do them themselves, or the custodian they may be using will say, well, hold on a minute, like we didn't sort of sign up for a 3 to 6 month sort of process when it comes to getting this over the line. So that's kind of a hurdle that they would face. But yeah, there is interest, but it does take the use of through a custodian that's already done the process, basically.
Yeah. So thanks, Rory. So Alex, actually, for high net worth individuals, I'm assuming now, given that the infrastructure such as on-chain and other services exist, that there would be an increase in demand, particularly in a hub like Singapore, which is known for its wealth management industry. Have you seen a recent uptick in high net worth individual clients using your service, or has it sort of been more of a steady trend?
A steady trend, I would say, with a bit more inquiries based on the current economical situation and the constant printing of US dollars by the Fed, which worries high net worth individuals who are sitting on a lot of cash, which is often US dollars. So they do see the stock market that is going up, but artificially, and expecting it to go down at one point because it's no longer correlated to the real economy. They see the printing of US dollars by the governments, making them almost impossible to get anything from their banks in terms of yields anymore. They therefore look at alternative investments, and digital assets are some of those, either as a way to invest into a startup that has a token issuance, or in the gold of crypto, which is Bitcoin. And in that case, they're looking for what they know. So a setup that they know with a custodian, preferably insured with the security and the trust that they would expect from a third-party providers holding their assets. So we've had interesting discussions with new high net worth individual customers who are looking at us as a provider. The remaining, I would say, hurdle, but I think all custodians have, is the compliance and regulatory uncertainties. Although in Singapore it's getting better, but it's still sometimes a bit complicated to understand for those guys. But I think, as I mentioned earlier on, we are now in a situation where enterprise grade solutions, both insured, compliant, with the right operational and technological environments, are available with products to generate yields way higher than what they would get from fiat currencies, for example. So I would say all the ingredients are there for attracting more high net worth individuals and family offices, or more traditional funds, for example.
Great. No, thank you for giving some context on what's going on with high net worth individuals. I definitely, personally assume that there would be a greater interest in this over time, and I think that Singapore is definitely well positioned jurisdiction-wise, given the regulatory clarity to leverage this, plus the existing wealth management industry. So as a kind of final round before we get into the audience Q&A, given the topic of this discussion is around this three-pronged approach to protecting crypto in terms of custody, compliance, and risk transfer. So Mrigank, I probably can assume what your answer would be, but how would you actually rank in terms of significance or importance for a digital asset business, those three areas?
Well, yeah, I mean, I'd like to say compliance, of course, but I think the answers, the three of them are actually, there's like interdependent, and having all three is actually necessary, because you can't have a compliance policy in place and your funds get stolen. You won't have a business, and essentially to hedge for risks such as your funds getting stolen. So at least in my opinion, the three would stack equally, and it's more, there's a sort of an interdependent relationship between them rather than a priority. Yeah.
Right. And do you think there's a fourth pillar or prong missing? Do you think there's another area that is equally important to those three areas that we haven't talked about?
So I was thinking about that, but I think that these are actually the basics of any business in this space, and I couldn't think of a fourth prong. I could only think of things that aren't too relevant, but would love to hear the others' thoughts on this, though.
Yeah, Rory, what's your take? First of all, and then the importance, and then secondly, if you think there is another pillar missing here.
Yeah, no, absolutely. It's difficult to say, of course, but ultimately, if you didn't have the compliance in place and the correct custodianship, then it's very unlikely that you'd be able to get the insurance. If you were, sort of any sort of average person on the street with X amount of digital assets, and you went to an insurance company and said, hey, look, you know, can you insure these for, you know, the total amount, and I'm not looking to pay any money, then they would sort of laugh you off a bit. So, you know, in some ways, yes, insurance is important. It serves a role, you know, it's not something that you want to use at all, but in the event that, you know, the unforeseen is something that you're going to rely on, that's obviously the role. But, you know, in a lot of other ways, it does play an important part in actually establishing a, you know, a recognition and a big part of the actual, I don't know, legitimizing the you know, the role of digital assets in our life. And I think it's certainly going to be developing as more and more important for the insurance industry to recognize this industry. In terms of like another prong, as it were, I guess it's kind of interrelated more with what Alex would be saying. But I think if we had to bring in another, say, panelist, maybe on the technology side would be interesting, just to really hear about what sort of new in terms of different ways in which, you know, the safekeeping of digital assets are going about. I mean, ultimately it's changed in the last 3 or 4 years. I can imagine in 4 years' time there'll be even more advancements in this sector. So it'd be interesting to see if there was someone on the hardware or technology software side whereby they're talking about their role in actually safekeeping it all. I mean, it's probably falls more into the custodian and their relationship with that technology company, but I think it would certainly be interesting to have someone else like that involved.
Great. And Alex?
Well, we define our business as a insured, secure, convenient, and compliant custody service provider in Singapore. So it demonstrates that as a custodian, we see those 4 points, so security, compliance, and insurance, as key. I mentioned an additional one, which is convenience. So I think one of the challenges of digital assets is user experience in general. And I think that's something that we need to work on a day-to-day basis, making sure that it's secure, yes, it's insured, yes, it's compliant, but it's also easy to use, and it's also practical to use. If everything is in cold storage, it's not practical to use, for example. So that's the 4th one that I would add. I would actually add a 5th one, which is professionalism and experience. We have a lot of players out there who are not professional, unfortunately, enough, and actually give a bad reputation to our industry. And on top of that, often they are not compliant. If you look, you will find generally they go together. And I think that's a challenge for our industry. It's still very immature. It needs to mature more in terms of professionalism. And the 3 topics we discussed today, custody, insurance, and compliance, are absolutely key to maturing this industry.
Great. No, I think those are all valid areas. I mean, my personal view is, I would definitely agree. Adding some equal emphasis to security, which is not just around protecting digital assets, but more about the organization itself, is also quite important, given that it's not just digital assets at stake, it's client information, it's company information, that sort of thing. And that's, I guess now perhaps even an easier target, given how sophisticated the solutions have become for protecting private keys, while it's still, not that difficult to get the CEO's passport off his computer. I mean, a copy of his passport. Definitely feel that there are many different aspects that digital asset firms should bear in mind when it comes to protecting digital assets. Given we have about 10 minutes left, I wanted to take a look at some questions that have already been posted by the audience. So if there is anyone else listening, joining, watching, that wants to ask a question to the panel, please feel free to type your answer, type your question into the Q&A, and then we'll try to do our best to address those. We do have a first question, which is around, what is the first step a family office should take if they are planning to increase their exposure to crypto? So is it up to the custodian to devise a holistic plan? So I assume that goes straight to Alex to get started. If you can offer some views on that, and then I'll ask Mrigank and Rory for some opinion.
Sure. So custodians, as I mentioned earlier, are not only doing custody. Generally, they have ancillary value-added services that are necessary to help customers navigate through the acquisition of cryptocurrencies and the safekeeping and investment of cryptocurrencies into products. So in our case, at least, we do not advise on investments. That's not our role. But we can definitely help our customers, high net worth individuals, for example, or family offices, navigate the complexity of who to talk to buy and sell. And we can help them with that. We have partners that can help them buy and sell cryptocurrency. We can also help and, of course, safekeep those assets and also introduce them to products that we know are trustworthy and that have a good and not excessive return on investment, like some DeFi products are today advertising with, honestly, are not making sense. So to present them to the right products and the right partners, professional partners that they sure will be able to help them with us at the back and make sure that at the end they still have their assets with a return that they deserve.
Rory, do you have anything else to add in terms of just the general topic of family offices approaching cryptocurrencies?
Yeah, no, and you know, I'll speak from an insurance perspective, as you may expect. But look, a family office traditionally, from an insurance point of view, will take out what's commonly seen as like an investment management insurance policy, and essentially it's like protecting you as the investment vehicle against, you know, it's family offices taking action against you as the investment vehicle for loss that they suffer, and that could relate to a basis claim that there hasn't been X amount of profit compared to what your mandate or whatever in the previous performance has been doing. So I guess if you're talking about increasing your crypto exposure from an investment point of view, if you haven't already got, you know, a policy in place that basically recognizes that it's a stakeholder or the investor, one of these family offices that are looking at your investment with more scrutiny, then it's something to think about, because ultimately you have regulatory issues that you might trip over. There's that investigation piece with something, you know, where it falls into securities that you might not realize, right through to, you know, a disgruntled third party that turns around and goes, I'm not happy with what's happened, therefore I'm taking action against you. So the insurance is never, you know, it's always going to be there, that in the event that there's some sort of dispute on that investment side, that you can lean on, even if it is just for defense costs, let alone, you know, a award in court that is damages to that third party, or again it could be a multi-family office. So that's what I would say.
Great, thanks. And Regank, I know it's not directly in the in kind of the wheelhouse of Miracle Science, but have you seen much sort of interest or demand, you know, with family offices, perhaps on the due diligence side when it comes to crypto compliance, or even on the investigation side?
Yes. So actually, we are seeing a lot of family offices enter the space, and I think in relation to the first question that was asked, the first point of contact is typically their asset manager or their fund manager, who understands the risk profile and essentially gives them a strategy on how to get into cryptocurrencies. And we are part of the ecosystem later on, is like when they organize a custody player for this family office, they also need to take care of compliance and then potentially insurance. So that's where we come in. But and in general, I think there is a lot more interest in this, not just from family offices, but also financial institutions globally, only because of the increase in regulations, and B, the uncertain economic scenario does make this an interesting alternative. So even though the stock markets are doing great, everybody knows that there is a bubble, and there is this belief that cryptocurrencies are somewhat inversely correlated to economies doing well. So that's why there's an increasing amount of interest there. And yeah, in general, also because this asset is the least correlated to all the other assets the family office invests in, they also see this as a chunk of their portfolio. So So we're definitely seeing increased interest here.
Great. Thanks everyone for answering that that first question from the audience. I've got a second one here, which is, I guess, more aligned with what Merkle Science is doing. So it's, how should the architecture of monitoring fraudulent transactions be set up for a bank to run smoothly, especially when clients are paying up on frequent margin calls from different wallet addresses? So it's a more very quite specific question, but how would you like to answer that, Mrigank?
Sure. So I think that's essentially setting up a risk process. So I mean, what Arindam does typically at SEBA. So this isn't related to compliance or AML that we do, but it's setting the right kind of risk process where if you have a certain margin call, or if you have a certain frequency of margin calls, you put in certain processes in place to, to ensure that nothing goes wrong. And I mean, this is also a very specific question. So maybe we can always discuss this if I have a specific use case. So I see a follow-up question there. How do you verify the addresses? So essentially what we do, at least, is we can check whether a wallet address is from an illicit source or from an entity such as an exchange, a custody provider, or a cryptocurrency payment service. I'm not sure how it ties into the margin call question, though. Thomas, do you have an idea there on what type of verification is being asked about here?
No. No, so I mean, what I would recommend is, given we're short on time, anyway, we're going to send an email out to all the attendees tomorrow morning. So I guess if they have more specific questions, they can just reach out to you directly, Mrigank, and ask those by email. In the interest of time, I think we can ask one more question. So we've got one, I think, which Rory can take the lead on, is if I want to insure my digital assets, what is the process and how long does it take?
Typically the process can take anywhere from 2 to 6 months. This really depends on like the level of sort of commitment and transparency as to the operations and technology that you basically rely on in regards to that safekeeping. But in terms of process, it starts off with pretty much a basic questionnaire. That'll be sort of the company's information and bits about sort of AUM and business plan, and really just getting the underwriters a brief overview of the business. And then from there, it really is a focus on that technology piece. So it will be, 6 or 7 pages of A4 questions that relate to everything from an end-to-end point of view when it comes to a customer turning up and saying, here's digital assets, I want you to keep it on my behalf, through to I want to withdraw every piece, and then understanding all of that sort of ecosystem that the company, the business is going through to make sure that it's kept safe. So that's the beginning. It's relatively simple, but it does then turn into what is quite an extensive process and due diligence from the insurers. They're most likely going to want to jump on a call and speak to you and have questions surrounding lots of different risks or risk controls you have in place. And then in some measures where the underwriters are just completely unfamiliar with some of, say, a technology or a process that you have in place, they'll go through and engage a third party to kind of do a bit more of an assessment and translate it into what is a bit more digestible from a loss point of view for them. It can take anywhere as short as a couple of months right through to 6 months and beyond, basically.
Great, thanks. Thank you, Rory, for the overview. So we're almost out of time. So we will be sending an email with the recording and then the contact details of the panelists for anyone that does want to reach out. Just wanted to know if any of you have any final thoughts that you'd like to share with the audience before we go offline. So Mrigank, maybe I can start with you.
Yeah, well, I guess the panel's been great. And to summarize, I think everybody understands that regulations are key, and it is evident that going ahead, like although the ecosystem is diverse and complex, people do need to move in the direction of being more compliant, making sure that they have custody of their assets, and also look into things like insurance, which were earlier ignored. So yeah, that's about it.
Alex?
No, I did enjoy. I think I will summarize by saying insurance, convenience, compliance, and security, the four important piece of the puzzle for family offices, high net worth funds, and more traditional players to come into this space. This is in place. The puzzle is complete at this stage. So, and the opportunities are there to not only invest into an alternative product that is, as you mentioned, not correlated to other assets, but also that can generate yields higher than anything other products that I know of. So it is ready.
Great. And Rory?
Yeah, no, nothing really more to add. It's been an enjoyable panel, and yeah, thanks for everyone's time.
Fantastic. Yeah, so thanks once again to all the panelists and for those that have joined today and for those listening to the recording later on. Yeah, thank you everyone. Enjoy the rest of your day.
Yeah, thank you everyone. See you.